how entrepreneurship funding is changing today on Builders Live.
Whoa. Where do you get the titles from?
It's incredible. I get Jeffrey Kaplan already excited. I'm Chris, the co-founder and publisher of Technically, a news organization for the community of technologists and entrepreneurs. And that incredibly excited man you heard is my guest today, Jeffrey Kaplan, the CEO of Optimist Ventures, coming from God's country, Asheville, North Carolina.
You know it.
Jeffrey, thanks for being here.
Yeah, Chris, great to see you again. Thank you for having me today.
Great to see you. Yes, good to see you again. We're going to cover some ground in our time together. Our road into conversation was how we're seeing the way entrepreneurs get funded shift in lots of communities around the country. But we're going to touch a couple points along the way. Can you first just give me the little bit of primer for listeners and myself on Optimist Ventures, what you're doing in Asheville, North Carolina, the role of ESOs, EDOs? Give me a little of that picture for you and Optimist Ventures.
I would love to do that. Thank you. So Venture Asheville is the official name of our organization, and we are one of 5 initiatives under economic development for Asheville-Buncombe County. Asheville is, as you said, in God's country, the beautiful Blue Ridge Mountains of Western North Carolina, beer city, foodtopia, climate city. We're a wonderful, funky, crunchy, progressive, creative, artsy city, which breeds a lot of tourism and hospitality here. There's some manufacturing. There is a lot of healthcare workers here, but it's always been the kind of town that has its reputation of a bring your own job kind of town. You know, and so when Venture Asheville started, it was an idea of, can the Chamber and Economic Development Coalition and the city and county come together to create an initiative to help people start homegrown, locally headquartered ventures? And that's really important because impact always follows founders. Even if you have, I'm trying to think of an example without naming names and putting anyone on the spot. Let's say you have a mega corporation in your town, maybe a Fortune 500 office in your town. It might be impactful, but not as impactful as the town where the headquarters is. Right. And so the same thing happens here. So even if we have a remote company or natively remote startup here in town, we will support the heck out of that company because the impact follows the founders. And so in economic development, our greatest kind of achievement is when we can mature a company out of the startup incubation, job creation, product market fit, maybe some early investment, and graduate them to the point where my colleagues in economic development are getting them county incentives to expand and stay here in town. It's happened actually a number of times. It's a huge success when we can graduate and mature a company that far that the county is saying, great, let's give them an incentive to stay here and grow here.
Right. All right. So then let's talk about the kinds of companies, because we've done lots of coverage at Technically around the very big umbrella that is entrepreneurship. We focus a lot on new firm creation, but economies have lots of different organizations. Tell me a little bit about the lens. What is the right kind of entrepreneurship that you're focused on?
So when Venture Asheville started 12 years ago, it was modeling after Austin, Boulder, RDU, Research Triangle area. And I think a lot of folks are still in this mindset of you got to have a B2B SaaS incubator in town that attracts the capital, that creates high paying jobs. Those get exits for multiples of revenue. And that's how you create wealth in your community. That thesis, I think, still holds. I just think when the rubber hits the road and you look at any town, it's, well, is the talent there? Is the capital stack there? Is the investment community, are they experienced in tech and startups? Are they familiar with the expectations of power laws and the venture finance math? And importantly, can your community absorb the losses in venture math? Right. So if you're making 10 venture or angel investments, you're going to expect 8 to 9 to fail and want to be that grand slam unicorn that makes your community really wealthy. In a small town like Asheville of 100,000 people, my approach has always been that our founders are really sacred, and not to be from a place of scarcity, but we can't afford those kind of failures.
Right.
You know,
Well,
people are trying to make livelihoods. They're trying to build generational wealth, and there's not as many funding opportunities or a funding pool so large that investors can also stomach those kinds of losses.
right. Well, and I love the framing there around, can you endure venture math? I think too often we get trapped in this like either or, when the reality is these are just different tools. And so what I heard you kind of calling out is your job as an ecosystem builder and as an economic development person is just to know there's a bunch of tools and what job are you trying to do. And in 250,000 population in Buncombe County, and as you said, 100,000 in Asheville, here are the tools that are going to best suited for us. We have a great culture in this place, so we want new firm creation, entrepreneurship to be shaping the community that is thriving here. That's going to look different than another place that wants to access venture math and have a different kind of economic flywheel. Why don't we move a bit then into the question at hand around entrepreneurship funding? So, I'll pull it up in a sec, but for a separate story, we recently had technically just pulled the kind of like basic window. Let's see if I can pull it up quick of what's going to happen. 6.5 million new firms were started last year. Here we go. So
I'm not gonna like that. I'm a little worried. I don't know where you're leading with this one.
Don't worry, I won't challenge your math on air. But instead, I want to pull it up so I had on hand. We have a good sense of what takes place. You get 6.5 million businesses started in the American economy last year. Oh, I can't zoom in anymore. Why is that not zooming?
I see that. 82% never hire someone. 50% closing.
Exactly. When you zoom in here and you look at any economy, 80% are never going to hire anyone. Yet 0.2% of the firms created will grow to 500 more employees. 0.5% will ever raise what we call venture capital. So when you look at that math, you will have to have a throughput of just a mass number of companies to build a strategy when 0.5% of all firms created will ever raise venture capital. 0.2% of companies will ever get to 500 employees or more. And so that's what I hear you talking about, of the responsibility of an economic development strategy, the responsibility of an entrepreneur support organization is to know this and say, if you're going to make that bet, then great. And you got to do capital access and capital readiness in a traditional way.
You just
jump in here. Or you say, let's look at different tools.
That's live on your site right now?
Yeah.
Okay, cool. I'm going to share that. Thank you for publishing that.
Oh, absolutely. Is it available for all of you to subscribe to Technically Builders newsletter? And I'll put it in the chat.
I agree with you, right? And then you take that math a little further. When you start breaking that down, right, I'm sure you've covered this, by gender or race, how infinitesimally smaller that 0.05% is going to get.
Yes.
I always kind of took issue with Asheville has such a strong cultural identity. It's the social fabric here. It's what ties all of our stakeholders together. Every community has a social fabric. Asheville's is really strong, really, really strong. And again, all those things I mentioned earlier, the funky, the crunchy, the creative, the artsy, the expressive, the inclusiveness of this area, that's our social fabric. And so to be trying to replicate an economic development model from other communities based on a funding thesis, and we've all been reading the same books, whether it's Startup Communities or Build the Fort, and I know all those guys, and they're great guys, those authors. It's adapting a playbook that worked there with the assumption it will work in your town.
Right.
And all those groups came out of venture finance. I think a quote I shared in our prior episode was, if I was a VC and I told you I made 10 investments, 9 are going to fail, 1's going to be a home run, you're going to say, yeah, dude, you're doing your job. That's, you are at the table. In economic development, if I told you, yeah, I'm responsible for growing a high growth entrepreneurship ecosystem here in little old Asheville, and 10 companies I'm working with this year, one's going to hit, I'm a really bad economic developer. My job is to maximize wins, increase the standard of living for as many people as we can.
Yep.
So, and with that social fabric is, instead of trying to be the next RTP, which we don't have the population, the universities, the funding
of Research Triangle
capital.
Park. Yep.
Yeah. How are we supposed to, like, why should we, where does that audacity come from that we can make what works in RTP work in Asheville? And for a lot of communities, it's right. What are the tools you have available? Can you foster what's growing in your community for greater impact? And for us, that looks like we kill it in CPG. We have amazing CPG companies here that grow really well and grow really fast. And this is a really interesting case study, and significantly informed Optimist Ventures, which is our fund and accelerator. We have so many farmers markets here in town, and people who are locals and visitors, of which we were getting 14 million a year visitors before the hurricane in 2024, was there is part of the social fabric is buy local. Pay more for something local because it's a local product, and you're supporting local and keeping local jobs and helping people survive here and live here and thrive here. So with the farmers markets, you can charge a premium for a quality local product, and it's really easy to break into a farmers market without a commissary from like your basement or your kitchen. You can be at the farmers market that weekend. So our companies who are at farmers markets, whether it's a vegan cheese company or a French pastry company, they get so much more traction, feedback, input from customers that you can make a change the next week. And when it comes time to scale those companies and everybody wants to get into grocery, retail, or wholesale, all those companies want to see your traction and momentum. So we were able to get our companies better traction, feedback, momentum, product market fit because of the farmers markets, get them into grocery stores, and that opens up the next level needs of funding. And so like that's been a big part of our thesis. And that's not tech at all. That's not B2B. That's not SaaS.
Right. So let's go on the funny part you just alluded to. Let's talk a little bit about the tools at hand. There are traditional ones and non-traditional ones. Give me your, if you're sitting down with an entrepreneur, let's say I just moved to Asheville and I want to lay the land. You don't even know my business yet. What's your visual of how I should talk about or think about my capital options?
Yeah, generally we're going to have three options for folks, and by category. The first is going to be CDFIs and credit unions, community development financial institutions and credit unions. They do small business loans anywhere from $5 to $250,000, right? $5,000 to $250,000. They need collateral, typically favorable interest rates. The next would be, our larger banks. We have a couple. We have one actually mid-sized headquarter bank here, Home Trust Bank, which will do lines of credit for folks. We got Truist Bank, Bank of America, Wells Fargo. They're all very involved, but often, for a business checking and savings account, we want folks going there, but they're usually not at the revenue levels to qualify for commercial or corporate banking yet. And then we've got some angel groups in town. We're part of the Venture South Network, which is a wonderful East Coast network from DC to Jacksonville, Florida. There's a couple local angel groups around here in Asheville, some up in Boone in the High Country. And if a company, let's say your company did happen to be a B2B SaaS company, we have relationships with the RTP, Research Triangle Park area funders that would be there. You got Venture South up there. But we want to be able to make a warm introduction. So part of my job is to have good relationships with all the funders in the region, so I can say, hey, Chris, you got to meet so-and-so. This is right up your alley, to give warm interest to those folks. So it's really always debt or equity.
And let me build on that, because thank you for that. That's helpful. Two of the things that we're seeing that I think are worth any ecosystem builder to know. One, network still plays an enormous role. Enormous. Yeah. We are seeing in the numbers, if you have a kind of network, you can fundraise in lots of different places. So we are seeing those stories of I went home or I chose to live in a place like Asheville because it's where I want to live.
Mm-hmm.
Because of my network, I'm able to raise from outside of home market. I'm effectively bringing money in to Asheville. So it sounds great if I can
We
do
love that.
So
We do.
there are those who are doing that.
So, but that's different post-pandemic.
Yes.
Pre-pandemic, our companies were raising money and had to move.
Yes.
The digital transformation across the world from the pandemic was companies could get investment and stay in Asheville now.
Yes. Yes. So that is real. It's still smaller. We also just did some reporting recently of some of the bigger hubs still, are big hubs. Don't discount the area yet. Now we were going to be joined by another guest. So I do want to put in another plug about what we see happening, because there are other, SSBCI funding states are accessing in different ways. There's lots of different programs that regions and states are trying to treat differently. We get a lot of pressure in our coverage to acknowledge that different regions have different focus on which subjects and industries and ambitions they want. And you spoke to that well, Jeffrey. Friend of the show, Heidi Knobloch from Homefield Fund, who was going to join us, but last minute wasn't able to. They're an interesting use case. I would just love to hear you give your reaction to Homefield Fund, which I can pull up here in a sec. But essentially, they help communities around the country set up small funds. These can be in the $1 to $5 million range. Don't quote me too much because I'm not Heidi.
So let me give a little context, and I haven't
touched
Optimist Ventures yet. Optimist Ventures is a fund we started after the hurricane with the support of one of our founders, Ginger Frank from Poppy Popcorn, pledged $100,000 to our fund. But she said, I don't want to do equity investments. I want to do grants. And so we wanted to find a way to split grants and investments under one umbrella. And Optimist Ventures, working backwards, seeing that a lot of every company starts with that classic startup pitch. They're going to get acquired or go IPO. And then we know that doesn't happen here. Acquisitions do happen from time to time, but not at the multiples of regularity you get in large markets. So working backwards, the question was, how can we create a fund that's going to be able to give a return to local investors, ideally in less than 7 to 9 years at a competitive rate? And so we created a document called the Shared Profit Agreement, the SPA note, we call it SPA. And our biggest expense was legal. Figuring out how can a 128-year-old nonprofit chamber of commerce create a for-profit fund concurrently with a new grant program. And it took us 1.5 years to do that, and a lot of fun, a lot of money. And then I learned about Homefield Fund, and it's like, oh, they could have done this all for us. We could have talked to Homefield, which does the fund management fund organization. There's so many unknowns we didn't know, and I've been managing angel groups, and I've raised angel capital, but I haven't started a fund before. And I did not know, how much I didn't know, from organizational documents to the cost to this kind of thing to the investor relations side of it. It's a lot to learn. And especially in a town like ours, there's not a lot of expertise in that. So if I known about Homefield Fund 1 year ago, we would have been all over it.
Really interesting.
Knowing it seems like a great organization. Yeah, as you see if you're watching this, they champion alternative investment vehicles, and alternative investment vehicles is really anything outside of debt or equity.
Right.
So we use shared profits. We don't do rev share. We purposely want to be the bottom line, up top line revenue share. But they do a shared earnings agreement also, and some other things. So I'm very impressed with Homefield Fund, and I look forward to finding ways to work with them.
So thanks for that shout out. I'm going to lose you here in a second. So maybe I'll widen out. Because I think the thing that is happening in our economy is, we've done a lot of this reporting yet technically. We have two very real tracks taking place within entrepreneurship. There is a very real high growth, technology, science enabled, raise a ton of typical equity financing, as it is like trying to follow venture math. It is trying to get the biggest swing ever. And that is part of our economy, and that is real. And some communities are pursuing that. It has some good, it has some bad.
Sure.
It is a strategy. And we also have seen overall entrepreneurship rates surge in this economy post-pandemic. But that is an open question about whether that will be all net good or net bad, because inside of those rates of entrepreneurship are a lot of people living in poverty. There are a lot of people who are have been pushed out of jobs for various reasons. And so I find it to be very inspiring and very motivational and very important right now for a class of economic developer and entrepreneurship leader to say, some of those people, we have an opportunity to help them end up not in a worse outcome than they would be, but in a better outcome. They might need tools or resources. They might need some mentorship. They might need some programming. Sometimes they might need capital. They'll sometimes over-associate capital. And that seems like the big picture we're operating, Jeffrey. So I wonder, to help close me out, so who needs to be doing this work in a given community? And if someone came to you and said, "Oh, I'm in this other city. I want to learn lessons from Asheville," what do you tell them?
Yeah. They want to learn the lessons from Asheville. What do I tell them?
The polite version, the
be patient, dig your well before you need your water. We're talking about the networking. When I started this job 8 years ago, the first 90 days, all I did was interview people. All I did was talk to founders, mentors, and investors in our current network at that time in 2018, and ask them the same 5 questions. Who are you? What do you do? Why are you a part of this? That's question 1. Question 2 is, what's good about our programs? What's bad about our programs? What do you like about our program? So different than good or bad, really trying, this is like customer discovery. And then the last question was, if we had a magic wand, what could we achieve together? And get those like dream state questions. And then after 90 days, had a lot of these dreams and ideas. And then I was able to take that back to the community and say, obviously I came from University of Florida. I came from a phenomenal ecosystem. I've lived in Charlotte, St. Pete, South Florida, Gainesville, and now Asheville. And I've seen lots of different strategies of ecosystem development. So I obviously had my own agenda, right? And things I thought would work, but that's, it doesn't really matter. What's there, what's in the community, and what can you foster and pour some gasoline on that fire and help it really grow? And so for us, we kind of discovered like tech-enabled lifestyle ventures do really, really well here, right? It's a small business with a product or a service, and the more technology that's behind the scenes and helping those founders be leaner and get better margins and therefore keep more profit is what we're really good at. Unfortunately, the current funding landscape didn't support that. Early stage ventures are afraid of taking on debt. They want to take on equity because worst case situation, they lose someone else's money, and we tell people like, look, if you can get debt at this early stage, take the debt. It's easier to pay off debt and have someone on your cap table forever and the expectations, and then you carry that emotional weight as well. So if someone's like, what can we learn from Asheville? Mentors and investors are really important. I think founders are the most important. Keeping your founders first, staying close to founder needs and what's emerging, and having ways to pipeline future founders. So we've done programs for employees of startup companies. We've done programs around employee ownership, trying to spread the wealth outside of a founder and give founder an exit into their company, through their employees. And when I started at Venture Asheville, I had never raised a venture round. I hadn't raised one before. And so I'm there giving tips on term sheets and negotiating and how to pitch, but I didn't really have the credibility. So while in this role, I started a dating site and raised venture funds on that, lost it all. And I think that made me much better at my job.
That's interesting.
Because to be able to talk to founders about their low points, I'm like, oh yeah, I've done it. I've had to have those calls with my investors and say, hey man, we are out of business. We have no more cash. Or conversations like, hey, investor, if you guys want to put in more cash, I talked to another investor and they wanted my previous round investors to put in more cash, and you guys want to put in more cash to signal risk. And they're saying, well, you're too high risk for us now. And, having really difficult conversations and trying to be as objective about it as possible.
Yeah.
It's tough. And I think founder-led is the way to go. You look at startup communities, they say it takes 20 years to build an ecosystem, but it has to be led by founders every time. Because when it comes from a public advocacy group, or even sometimes out of a university or a tech transfer office, which you see a lot of those too, again, those are just multiple tools. There has to be an holistic approach to ecosystem building. But if your founders are not at the center of it, you're guessing.
Yep.
Just guessing.
Jeffrey Kaplan, CEO of Optimist Ventures, and the leader of Venture Asheville. Thank you for that insight, Jeffrey.
Thank you, Chris. Thanks for having me on today.
See you next time. Bye, everybody.